Imagine dedicating decades to building your retirement savings only to be forced by the government to withdraw a portion of it, regardless of whether you need the funds or not. It's pretty frustrating, right? Well, that's exactly what required minimum distributions, or RMDs, are designed to do. But what if I told you there's a way to reduce, delay, or strategically bypass these mandatory withdrawals? Today, we're going to explore the most effective strategies to handle RMDs, ensuring that your hard-earned savings continue to work for you instead of being prematurely depleted. Don't let RMDs limit your financial freedom. Let's discover how you can take control of your retirement savings. If we haven't met yet, I'm Jonathan Rankin, the owner of Theorem Wealth Management, a retirement planning firm, and we've been helping people across the country plan and execute their retirement goals for going on 20 years now. Today, we're tackling a question that puzzles many retirees. What can you do if you don't need or want to take your RMDs? Let's break down the rules, the strategies, and the opportunities that you might not have considered. Now, starting off with the RMD basics. The RMDs are a fact of life for anyone with a traditional 401k or IRA. Once you hit a certain age, currently it's 73, but it's rising to 75 for those born after 1960, you are required by law to withdraw a portion of your savings every single year. Now, the IRS calculates this amount by using life expectancy tables and the balance of your account at the end of the previous year. So, for example, if you're 75 years old with a $700,000 IRA balance, then your RMD for the year would be around $26,515. Now, failing to take your RMD comes with a huge penalty, up to 25% of the amount that you were supposed to withdraw. However, recent changes under the Secure 2.0 Act have actually reduced this penalty to 10% if it's corrected promptly. But what if you don't actually need this money? Let's explore your options. Now, one of the most popular strategies to minimize RMDs is converting part of your traditional IRA to a Roth IRA. And here's why it's a game changer. You see, Roth IRAs, they're not subject to RMDs during your lifetime. Now, here's how it works. During the conversion process, the amount you move is taxed at ordinary income. To avoid pushing yourself into a higher tax bracket, a lot of retirees convert smaller amounts over several years, just to top off their current tax bracket. Now, the benefits? Well, your money grows tax-free and there are no future RMDs. And when your money's passed to the beneficiaries, Roth IRAs comes with significant tax advantages. However, keep in mind the 5-year rule. For each conversion, funds must stay in the account for 5 years to avoid penalties on earnings. Now, the second option you have is that you can actually reinvest your RMD. If you have already taken your RMD for the year but don't need the funds for living expenses, then reinvesting is an excellent option. And while you can't directly roll your RMD into a Roth IRA, you can, however, put that money into a low-cost, tax-efficient investment that will allow your savings to continue to grow without triggering excessive taxes. Now, the third option you have is a qualified charitable distribution, or QCD. If giving back is part of your retirement plan, a QCD might be a perfect solution. See, with a QCD, you can donate up to $100,000 per year directly from your IRA to a qualified charity. Now, the amount satisfies your RMD requirement, but doesn't count as taxable income. Now, this strategy could also lower your adjusted gross income, potentially reducing Medicare premiums and the amount of your Social Security that's subject to taxation. However, the donations must go directly from your IRA custodian to the charity to qualify, and the organization must be an IRS-recognized 501c3. The fourth option you have is you could keep working. Did you actually know that if you're still working and contributing to a 401k with your current employer, you may not have to take RMDs from that account? This exception applies as long as you don't own more than 5% of the company. See, for those who love their work and don't mind staying employed into their 70s, then consolidating old 401k accounts into your current employer's retirement plan can actually delay RMDs, keeping your savings invested longer. See, RMDs, they may feel like this unavoidable hurdle, but with careful planning, you can minimize their impact or even turn them into an opportunity. Whether it's through strategic Roth conversions, reinvesting your withdrawals, charitable giving, or staying in the workforce, the right approach depends on your goals and circumstances. Have you tried any of these strategies yourself? Or do you have a unique approach to how you're handling RMDs? I'd love to hear your thoughts. Drop a comment below and share your experience. If you found this video helpful, make sure you hit that subscribe button, because we're going to continue to put out retirement videos just like this one to help you make sure you maximize your long-term retirement. Thanks for watching, and I'll see you next time.